Right now, somewhere inside your banking app, there's a number quietly disrespecting you. My name is Nick, and if you bank with one of the three largest banks in America, that number is 1/100th of 1%. Which means my friend Yvette, who has faithfully kept $31,000 parked at the same bank since she turned 22, earns $3 a year. 3. Her brother-in-law Curtis holds nearly the same amount, same federal insurance, same zero risk, and he earns about $1,350. That's roughly 450 times more. Curtis isn't smarter than Yvette. He simply filled out a form while half watching a cooking show, 15 minutes total. And if your money is sitting where I'd bet it's sitting right now, you're on the losing end of that same number today. Every finance channel online is calling this the great high-yield savings comeback of 2026. It isn't a comeback. It's something far stranger, and Curtis is about to show you exactly why, right after he nearly loses everything. Quick heads up before we dive in, every rate mentioned today shifts, sometimes weekly, so verify current numbers before acting on anything here. I'll give you a checklist at the end. Let's start with your gap, because you almost certainly have one, and it's larger than you'd expect. The top high-yield savings accounts in America currently pay up to 4.5%. That's what's actually available to you. The Federal Deposit Insurance Corporation surveys over 500 institutions and publishes what Americans really earn instead, and that figure sits at roughly 0.38%, unchanged since April. So the typical saver earns about 1/12 of what's actually out there, and that's the generous version, since online banks are the ones pulling that average up. If your money is sitting in a traditional brick-and-mortar bank, you're earning about 1 penny per $100 annually. Leave $100 there for 12 months and you'll earn exactly 1 cent. A vending machine wouldn't even accept that. Here's why this is worse than simply boring. Inflation in June came in at 3.5%, with core inflation at 2.6%. So your money isn't just sitting still, it's actively shrinking. Every year it stays put, it buys you less. Yvette's $31,000 loses roughly $1,000 in purchasing power annually, while her bank rewards her with $3 for the inconvenience. Curtis, meanwhile, outpaces inflation by about a full point. Same country, same week, same risk level, entirely different outcome. And almost every video covering this topic gets the story backwards, because here's the truth about this so-called comeback narrative. Rates didn't actually come back, they fell. Back in the summer of 2023, top accounts were paying over 5%. Then the Federal Reserve cut rates 6 separate times between September 2024 and the end of 2025, dropping the federal funds target from 5.25% down to 3.5%. Banks passed that reduction along to savers immediately, enthusiastically, and completely. And by immediately, enthusiastically, and completely, I mean they slashed your rate far faster than they ever bothered raising it. That 4.5% you see today isn't a recovery story. It's the tail end of a long, quiet decline. So why is everyone suddenly buzzing about savings accounts? 3 reasons, though only one of them should really matter to you. First, the rate cutting has stopped. The Fed has held steady all year, and at the June meeting, 9 out of 19 officials projected the next move would actually be a hike rather than a cut. Second, inflation ticked back upward, prompting people to finally check whether their savings were keeping pace, and yours probably isn't. Third, and this is the one that genuinely matters, for the first time in about 15 years, a plain, boring savings account can beat inflation without you doing anything clever at all. Not back in 2009. Not in 2021, when the national average sat at 0.04% and your savings were quietly evaporating. Right now, boring actually works. So the real comeback isn't that rates suddenly got good, it's that they stopped getting worse and people finally paid attention. Which leaves you with a much better question. Where has your money been parked for the last 3 years, and who exactly has been pocketing the difference? The answer has a rather unmemorable name: deposit beta. Deposit beta measures how much of a Federal Reserve rate change your bank actually passes along to you. If the Fed raises rates a full point, and your bank raises yours by half a point, that's a beta of 50%. Simple enough on paper. Here's the part that isn't simple. Researchers examining U.S. banking data across multiple rate cycles discovered that deposit beta is asymmetric, and the asymmetry runs in exactly the direction you'd expect. When the Fed cuts rates, your bank cuts you quickly and completely. When the Fed raises rates, whatever reaches you is slow, partial, and frequently indistinguishable from nothing at all. You absorb every loss and wait patiently for every gain. Researchers politely described deposit pricing as downward flexible and upward sticky, which is an expensive way of saying the elevator only travels down while someone quietly set the stairs on fire. Now watch what this actually did to a real person. Between 2022 and 2023, the Fed ran the fastest hiking cycle since the 1980s, moving from 0 all the way to 5.25% in about 16 months. Over that same stretch, Yvette's bank moved her savings rate from 0.01% to, brace yourself, 0.01%. Congratulations, Yvette. 16 months of the most aggressive monetary tightening in 40 years, and your reward amounted to absolutely nothing. They didn't fail to pass along those gains, they simply chose not to, and it worked because almost nobody left. Which is exactly where this stops being your personal problem and becomes a national accounting problem. Americans collectively hold roughly $10.2 trillion in savings and checkable deposits, trillion with a T, and your money is somewhere inside that enormous pile. A significant chunk of it sits earning under 0.5%, while 4.5% is available to literally anyone with a phone and 10 spare minutes. Curtis was part of that same pile too, right up until last spring. Over the 2 years he spent doing nothing, he gave up roughly $4,000 in interest, which remains one of the easiest ways ever devised to lose $4,000. The platform Raisin estimated that if every household switched to a competitive rate, Americans would collectively earn about $396 billion more annually. I'll be upfront. Raisin sells access to these accounts, so treat that figure as directional rather than gospel. But even cut it in half and you're still looking at roughly $200 billion a year that legally belongs to people, carries zero risk, and simply goes uncollected. Now let me correct a number you've almost certainly encountered before. You've probably heard that the average American household holds $62,410 in the bank, usually cited by someone trying to make you feel behind. That figure is nearly meaningless, so ignore it. The median household, the one genuinely in the middle, the one you're far more likely to resemble, holds about $8,000. The average is nearly 8 times higher than the median because a small number of extremely wealthy households drag that number way up. Whenever you see an average balance quoted without a median alongside it, someone is either being careless or trying to sell you something. And that survey data dates back to 2022, making it 4 years stale already. So you're probably not sitting on $60,000, you're closer to 8. And I know exactly what you're thinking right now. You're thinking, well, Nick, on $8,000, the difference only amounts to about $330 a year, and that's not going to transform my life. So why bother at all? That's a completely fair objection, and let me answer it properly. $330 covers your car insurance deductible. It's a flight home. It's the emergency cushion that stops one bad week from turning into a credit card balance you're still carrying 2 years later. And you earn it for 15 minutes of typing, which works out to over $1,300 an hour. You won't be paid that rate for anything else you do all year, and then it scales alongside you. The day your balance reaches $20,000, that same 15 minutes becomes worth $800 annually. At $50,000, it's over $2,000. You're not doing this for the balance you currently have, you're doing it once for every balance you'll ever hold going forward. So your money is genuinely real, and the gap is genuinely real too. Which brings us to the actual question this video is asking: why haven't you moved it yet? The research here is almost comical. The average American has banked with the same institution for about 17 years, longer than most cars last, most jobs last, and an uncomfortably large share of marriages last. 36% have never even considered switching banks. Surveys on rate awareness vary wildly. One 2026 study found only 7% of Americans earning 4% or better, another found 22%. But they all agree on the general shape. Somewhere between 25% and 40% of people simply cannot tell you their own savings rate. I want to be very clear here, this isn't about you being lazy. Your direct deposit is already routed there. Your auto pay is already linked. Your entire bill history lives there. Yvette's debit card has been in her wallet so long the numbers have worn completely smooth, and that card is doing more to keep her money trapped in place than any interest rate ever could. Switching banks feels like an entire Saturday lost to paperwork, so it gets pushed to next Saturday, then the one after that, and nobody is ever going to interrupt that cycle for you. No bank is mailing you a letter that says, "We're currently paying you 1 penny per $100, and there's an institution down the street paying 450 times that amount." That letter simply doesn't exist. Writing it isn't anyone's job. You were never failing at this. There was simply never a built-in moment in your life where anyone was going to tell you. The entire relationship is designed around the quiet assumption that you won't check. And statistically, they're right. By the way, this is precisely the kind of thing we break down inside our school community, where we work with actual numbers instead of vague vibes, links in the description. Now, Curtis, I promised you Curtis because Curtis did everything I'm telling you to do right now, and it very nearly cost him everything. When Curtis moved his money, he did exactly what you do. He searched for the biggest number available, and the biggest number is almost never the right one. Some advertised rates are purely promotional and quietly reset after 3 or 6 months, long after you've stopped paying attention. Others are tiered, where the headline rate only applies to your first slice of savings while everything above that earns practically nothing. There's a credit union currently advertising 10%, which sounds incredible until you read the fine print showing it only applies to your first $1,000. That's $100 a year, essentially one nice dinner for correctly spotting a marketing gimmick. But Curtis's real mistake was subtler, and it's the part I most need you to take away from this. Several of the best rates he found weren't actually offered by banks at all. They came from apps, sleek interfaces, friendly design, and a tiny line of text reading FDIC insured. Here's what that line actually means for you. Federal Deposit Insurance covers $250,000 per depositor, per insured bank, per ownership category. Apps themselves are not banks. They partner with banks and funnel your money into shared accounts where insurance is supposed to pass through to you, and that pass-through depends entirely on someone, somewhere maintaining an accurate record proving that money is actually yours. In 2024, a middleware company called Synapse, which sat between dozens of these apps and their partner banks, went bankrupt, and over 100,000 people found themselves locked out of their own money because the ledgers had never been properly reconciled. At one app alone, roughly 13,700 customers who had deposited about $65 million combined were offered a total under $12 million. There are documented cases of people who deposited tens of thousands of dollars only to be told the bank had just a few dollars on record under their name. That money was technically sitting inside FDIC insured banks the entire time. Here's the distinction that should genuinely concern you. Insurance protects you when a bank itself fails, but it does absolutely nothing when the company standing between you and that bank simply loses track of your money. Curtis had moved $30,000 into one of these apps, chasing an extra 15 basis points, which on $30,000 works out to $45 a year. He got out before anything went wrong, but that was the trade he nearly made, risking real exposure to catastrophic loss for $45. So when you're comparing accounts, your first question shouldn't be what's the rate. It should be whose name is actually on the charter. Ask that before anything else. Curtis learned that lesson, and then he learned the second one, the one nobody ever mentions: taxes. Your savings interest gets taxed as ordinary income both federally and at the state level. Interest earned on U.S. Treasury bills is fully taxable federally, but exempt from state and local income tax. So the comparison you'll see on rate comparison sites, 4.5% in a savings account versus 4.15% on a one-year Treasury bill, isn't actually the comparison that matters for you personally. If your state taxes income, that seemingly bigger number can end up losing. Run the math for a top bracket earner in California, and 4.5% in a savings account nets about 2.2% after tax, while that same rate from a Treasury bill nets closer to 2.8% because the state never touches it at all. That's roughly 27% more after-tax income for a nearly identical asset. Live in a state with no income tax, though, and that advantage disappears entirely. and the savings account wins purely on convenience. So your correct answer genuinely depends on your zip code, which is an incredibly annoying thing to be true, but there it is. Yvette, for what it's worth, lives in Ohio and carries a modest balance, so she should skip the Treasury bill research entirely and just open the savings account. Half of getting this right is simply knowing which half you're allowed to skip. And by the way, this same gap shows up everywhere. The national average one-year CD pays just 1.65%, while the best available ones pay 4.35%. This was never really a savings account problem, it's a shopping problem. Now, before you build yourself a bunker made entirely of Treasury bills, let me argue against my own point for a moment, because a video about savings accounts that skips this part is really just an advertisement. Cash is a terrible place to build long-term wealth. Over the last century, there hasn't been a single 20-year stretch where U.S. stocks lost money. Not one. Over 20 years, $10,000 invested in stocks has historically grown to something like $67,000, while the same amount left in cash grows to about $18,000. That gap is essentially the difference between retiring comfortably and having a long, awkward conversation with your kids about their spare bedroom. But 2026 is a genuinely unusual year, and here's why. Vanguard's 10-year forecast for U.S. stocks, published in January, projects annualized returns between 3.9% and 5.9%. Cash currently pays around 4%. When a full decade of expected stock returns barely clears what a savings account offers today, holding more cash becomes more defensible than it's been in 15 years. That's a model, not a guaranteed prophecy, and models have been wrong about stocks for most of my adult life, but it's still a legitimate argument, and it means just invest. Everything is lazier advice this year than it usually would be. So here's where your cash actually belongs: your emergency fund, 3 to 6 months of living expenses, money you'll need within 1 to 3 years, and sinking funds for things you already know are coming. New tires, an insurance deductible, that wedding you're attending whether you want to or not. And I want to dwell on that emergency fund for a moment, because only about 46% of American adults can currently cover 3 months of expenses. That statistic isn't just a statistic, it's the difference between a transmission failure being an annoying weekend versus becoming the start of a debt spiral. It's the difference between being able to say no to a job that's slowly destroying you or not. 4.5% won't make you rich, but it makes your financial cushion grow while you sleep instead of shrinking while you sleep. Yvette's cushion has been quietly shrinking for 19 years, and she's never once been told that everything beyond a 3-year horizon belongs somewhere with real upside potential. Park your retirement savings in a basic savings account because the rate felt safe, and you'll have successfully protected yourself from entirely the wrong danger. Which brings us back to Yvette, and to the only math I actually need you to remember. Yvette has $31,000. A year from now, at her current rate, she'll have $31,003. In a competitive account, she'd have about $32,400, $1,300 for filling out a single form. Now stretch that out further. $30,000 left at the national average for 10 years becomes roughly $31,000. That same $30,000 at 4.5%, assuming rates hold, becomes roughly $46,500, a $15,000 difference. Identical money, identical risk, conjured from nothing more than one Tuesday evening and a bit of mild irritation. So here's your checklist, essentially Curtis's checklist, one he paid for the expensive way so you wouldn't have to, and it's short enough to run through tonight. Confirm your rate is permanent, rather than promotional. Confirm it applies to your entire balance, not just the first slice. Confirm you're depositing with an actual chartered bank or credit union, not simply an app sitting on top of one. Stay under $250,000 per bank per ownership category. And if you live in a high-tax state with a meaningful balance, run the Treasury bill comparison first. That's the whole move. I'm not a financial advisor, and none of this constitutes financial advice. It's just arithmetic. And you should absolutely double-check my arithmetic yourself. Our school community is free and the link is below. But here's what I keep coming back to. The high-yield savings comeback of 2026 was never really about interest rates at all. Rates went down, the banks didn't suddenly become generous. The Fed didn't turn kind. Nothing was handed back to you. The only thing that actually changed is that enough people finally paid attention. Yvette's money didn't underperform because she made a bad decision. It underperformed because she never made a decision at all, and the entire system was built patiently and profitably around the assumption that you wouldn't either. Curtis didn't beat her because he was smarter, braver, or better with money. He nearly torched the whole thing chasing an extra $45. He beat her simply because one evening he actually looked. So go look. Not at the stock market, not at your portfolio, not at anything remotely complicated. Open your banking app, find the interest rate on your savings account, and say that number out loud. If it embarrasses you, congratulations. You've just discovered the highest paying 15 minutes available to you all year. And unlike nearly everything else in personal finance, this one doesn't require you to correctly predict the future at all.